Should you take your tax-free cash when you retire? See, many people face a big decision about their pension tax-free cash, and this choice can have a lasting impact on your retirement. See, you might be wondering if taking it now is the smart and the right thing to do, or maybe you should leave it where it is and take it later down the line. In today's video, I'm going to help you think this through properly. So we're going to cover what tax-free cash actually is and how it works. And then what we're going to do is we're going to look at 5 important questions you need to ask yourself. And these questions will help you decide what's right for your situation. So my name's Zach Hussain and I'm the founder of financialeducation.co.uk, and I've got over 25 years experience of helping people plan for their retirement. Let's start by understanding what tax-free cash actually means for you. Most pension schemes will let you take 25% of your pension tax-free, and this normally comes out as a lump sum when you access your pension, and you can usually take it from age 55 onwards. The amount that you get depends on your total pension pot value if it's a DC scheme. So if you have £200,000 saved up properly, you can take a quarter of that, which is £50,000, completely tax-free, and the rest stays invested in your pension pot for you to draw down later down the line. See, this tax-free element is a valuable benefit for UK savers. See, not many countries offer this kind of tax break, but taking it has consequences you do need to think about, because once you take it out, the money leaves your pension. It won't grow in that tax-free environment anymore, and this is where people more often than not make mistakes, and this is because they haven't done their planning properly. So you need to understand both the benefits and the costs of taking your tax-free cash, because taking tax-free cash is not automatically the right move for everyone. The first thing to ask yourself about taking your tax-free cash is your immediate needs. Do you genuinely need the money in your hands right now? Because what I find is that many people take their tax-free cash just because they can access it and someone said they can have it. But for me, that's not a good enough reason on its own. What you need to do is you need to think about it carefully. Why do you want to take that money out? Do you have debts that are costing you money every month and you can use it to pay that off? Do you still have a mortgage outstanding? And again, you can use the tax-free cash to pay your mortgage off. Are there essential repairs on your home that are needed? In which case, that's a very good reason to use the tax-free cash. See, these are all valid reasons to consider and ones that would be worthwhile doing. But if you're just thinking of taking it because it's a nice to have and you want to look at the money in your bank account, probably isn't a great enough reason to do it, in my view. And I think if that's the reason, you probably do want to consider carefully your decision, whether that is the right thing for you to do. Because leaving your money where it is in your pension allows it to grow tax-free, and any gains on it are tax-free. And of course, it's protected from creditors if things were to go wrong financially. The last thing, of course, is you can't just accidentally spend it on any impulse purchases. So what you do need to do is ask yourself honestly whether you truly need it now. So what will you do with your money when you've got it? See, this question about your plans really matters. See, having a clear purpose makes all the difference to your decision, in my view. See, some people want to pay off their mortgage completely, as I said earlier on. You can save thousands in interest over the remaining years, so that's a really good use of your tax-free cash. Others need to clear credit cards or debts, personal loans, and again, these are probably high interest debt. So paying that off and clearing that debt is a good use of your tax-free cash. And of course, maybe you want to help your children or your grandchildren get onto the property ladder, or you need to make home improvements for accessibility, or you have care needs that need paying for. So these are all good reasons to use your tax-free cash. So these are planned uses that can improve the quality of your life, but lots of people take the money with no real plan. What they do is they think they'll invest it wisely in stocks and shares, but then it sits in a current account earning nothing. And of course, they could end up paying tax on their gains if they do invest it in stocks and shares. Or what they end up doing is spending it gradually on everyday things without really noticing it. And before they know it, all that money has disappeared and has all been spent. So if you can't clearly answer what you'll do with the money, you need to think about whether taking that tax-free cash is going to be the better choice or whether leaving it in your pension is the right thing to do. Now, let's just take a slightly different perspective and talk about what you lose by taking your tax-free cash. So this is where many people don't really think things through, in my experience. Because when you take your tax-free cash out of your pension pot, you're removing what would have kept growing tax-free. So let's imagine you take out £50,000 age 55. That money could have grown significantly over 10 more years. So inside your pension, it grows without any tax on its gains. outside of your pension, well, you're going to end up paying tax on any investment growth, unless of course you put it into an ISA. You'll also lose the protection that pension offers from creditors, and you might spend it without meaning to over time. You see, that money that stays in your pension just keeps working for you. It can still be invested in funds that hopefully will continue to grow. And of course, this compounds itself over time and can make a big difference. So you're giving up future growth and tax benefit, which is why I think you need to weigh this cost against the reasons for taking it. The impact on your future income is also a really important consideration here. So taking tax-free cash reduces the pot that generates your retirement income. So if you have £200,000 in your pension, you can take £50,000 of that totally tax-free. This means that you're left with £150,000 for income. That smaller pot will generate less income each year going forward. So this might not matter if you have other income sources. Maybe you've got a rental property or you've got a final salary pension that you can start to access. But if this pension is your main income source, then reducing it by 25% is a really big deal. So what you need to do is work out how much income you're actually going to need, and then see if the remaining pot can provide that reliably. So you remember, and most people don't really think about this, you might need income for 20, 30, even 40 years. So running out of money in your 80s is going to be a real big worry. So make sure you can afford to reduce your income pot. Don't just focus on the tax-free cash lump sum now. Think about how much money you're going to need and how long you're going to need it for, and how it might be better to spread what you've got out over a number of years rather than just reducing it by 25% in one hit. It's also probably quite helpful to think a little bit broader. See, tax and inheritance planning might affect your decision significantly, because money in your pension is usually free from inheritance tax. So if you die before 75, it passes on completely tax-free. After 75, it's taxed as income for your beneficiaries, but it still avoids the 40% inheritance tax charge. So if you take the money out and add it to your savings, it might cause an issue. And these rules themselves are going to change from April 2027. So that money that you've taken out now automatically becomes part of your estate for inheritance tax purposes. So taking tax-free cash could create a future tax bill. And this matters if your estate might exceed the threshold. You also need to think about your own tax position right now, because if you're still working and paying higher rate tax, taking tax-free cash and spending it might make sense. But if you're a basic rate taxpayer in retirement, the benefits of keeping it in your pension are, for me, much stronger. So what I recommend you do is talk to a financial advisor about your specific tax situation, and what they can do is help you work out what the best approach is in terms of when and how you take your cash. Now, let's bring all these considerations together with some specific questions you should ask yourself. And sit down and honestly answer each of these for yourself. The first one to ask yourself is if you have a clear and specific purpose. Can you name exactly what the tax-free cash is going to be used for? Second, ask if that purpose is more important than growth. Would paying off debt or helping family outweigh any future lost investment returns? Third, ask if you can afford less future income. Can you manage comfortably with a smaller pension pot later on in life? Fourth, ask about your other income sources in retirement. Do you have enough money coming in from elsewhere to manage? Fifth, ask about your health and life expectancy and think about that honestly. Might you need this money sooner rather than later? And sixth, ask about inheritance tax on your estate overall. So could keeping money in your pension save your family tax in the future? See, these questions will help you think through your personal circumstances properly. Don't just follow what your friends or family have done. You need to think about it, what it means for you, because your situation is unique and deserves careful thought and planning. So let's wrap up this video. We've covered the key questions about taking tax-free cash. As I keep saying, the decision is personal and depends on your very specific personal circumstances. See, taking tax-free cash is a valuable benefit from your pension scheme, but by taking it, it does mean that you're giving up future growth and protection. And that's why I keep saying you need to have a clear purpose for the money before taking it. So paying off expensive debt can often make good financial sense, but taking it without a plan, usually, in my experience, having spoken to people that have done this, leads to regret. So think carefully about how it affects your future retirement income, because a smaller pension pot obviously means less income for the rest of your life. And consider the tax implications both now and for inheritance. Money in your pension currently avoids inheritance tax. So take time to work through all the questions I set out in the previous slide. And if you're still struggling, talk to a financial advisor. They can help talk you through your circumstances and paint a fuller picture, a financial picture for you. And lastly, don't rush this decision just because you've reached the age where you can take your tax-free cash. The right answer for you may well be a different answer for other people. So make your choice based on your needs and your circumstances. So lastly, good luck.